Let's welcome on board then Pratik Gupta and find out what he's making of the market right now. Pratik, hi, good morning. Great to have you on the show as always. Well, just a dash, a little bit more, and we'll make it to that all-time high. Are you surprised, Pratik, by the kind of appetite that one is seeing in the market and resilience in spite of the kind of valuations that we all get worried about?
Yeah, there is a little bit, obviously, it's being driven by very, very strong local domestic flows. What we are seeing is, on one hand, the foreigners have not been aggressively selling India, or they've been maintaining their somewhat overweight to neutral positions in India despite the expensive valuations. And meanwhile, we've seen very strong local flows, which is leading the market higher. And partly that's because of the low post-tax returns in some of the other investment alternatives, whether it's fixed deposits or fixed income products or real estate also, which is not seeing too much of a price appreciation. So in that context, yes, it's been a very pleasant surprise, the strength of the Indian market. Honestly, the one question which everybody keeps asking us is, how long can this continue? And honestly, no one knows. These retail flows can go on for several more quarters, several more years. You had the US, for example, in the 1980s when the 401k flows started. That went on for a very, very long time. The same thing we saw in Japan back in the mid 80s. We saw this in China in the 2000s and the early 2010s. Perhaps in India, we could be seeing something like this going on for some more time. So that actually is a very, very pleasant surprise, and it's great for the markets for long-term investors as well.
Sure. But Pratik, where is it that you would advise caution right now? I mean, I'm sure the messaging is not to put fresh money to work, but where is it that you would be like, it's advisable to at least take some chips off the table, if not fully?
So I think, firstly, by and large, just to put the context over here, we think the market overall is somewhat expensive. We're trading at 22 times one-year forward earnings. We're trading at a 90% premium to the MSCI Emerging Markets Index. That's the MSCI India versus the MSCI EM market. Historically, the range has been, say, 30 to 90%, and we're literally at the top end. If you look at the Nifty multiple of 22 times, that itself is about almost 2 standard deviations away from the long-term average. So we are definitely at the high end. If you look at our performance for this year, India's Nifty is up about 15% in rupee terms. Put that in context, only the US market has done somewhat better. If you look at the mid-cap index, that's where the froth is in our view, where the mid-cap index is trading at almost a 50% premium to the Nifty. And yes, granted, you will probably see better, higher growth in earnings in some of those cases. But typically, these stocks trade at a discount because of either governance or scalability concerns, or balance sheet concerns, or liquidity concern, the cost of entry and exit into these kind of stocks. It's the opposite right now, wherein small caps and mid caps in particular, are trading at a significant premium. So I'd say mid caps is one area where, as a category, one should be somewhat careful. Small caps in particular, wherever there is very low free float, that's another area where I would caution. But as sectors, I would say, there's no broad brush as such, I would say. But for example, I'll just highlight a couple of examples of sectors which we think are expensive. One is the chemical sector, where valuations for most stocks are still, anywhere between 30 times to 40 times 1 year forward. These are businesses where we are seeing still very, very strong competition from Chinese companies. The demand environment remains weak. We think there's a risk of further earnings downgrades. Oil and gas is another sector where we're seeing companies embarking on very heavy capex. There is a lot of dependency on government policy, regulations. Capital allocation remains a concern, and valuations are not necessarily cheap. So oil and gas is another one. The other one could be, let's say, the paint sector, where the incumbents are facing competition from a new entrant, and things still haven't stabilized. So these are just some examples of sectors. So wherever you see risk of earnings downgrades or competitive intensity increasing or government policy uncertainty, those are the areas we would generally avoid.
Morning, Pratik. So, what's the stance that you have when it comes to PSUs? We're just discussing this a bit extensively, given the fact that there has been that pretty strong run up within the space. Would you exercise caution within the space, look at select stocks, or believe that yes, there is pricing power, there are strong government initiatives, and this is a space to look at from a basket view?
So I would say look at select stocks. I don't think you can take a basket view. The PSU space is too broad a brush. There are obviously depends on which sectors they're in. So for example, the PSU banks, I think most of them have turned around in terms of the balance sheet quality, the asset quality, the credit costs are now under control. They have a much better liability franchise than many of their private sector counterparts. So the PSU banks, in our view, we still think generally quite decent. On the other hand, let's say the defense stocks, the defense PSUs, these are also great businesses from a very long-term perspective, 5-year, 10-year perspective. We think the defense cycle is going to be very strong. But in the short term, these stocks have run up very sharply. They've been some of the best performers. So at current valuations, most of these stocks are trading for anywhere between 35 to, in some cases, 55, 60 times 1 year forward earnings. And that we think is quite expensive for a sector where the orders tend to be quite lumpy. Margins keep going a little bit up and down. There's a lot of volatility, and most importantly, this kind of growth in the order book may not sustain after the initial bump ups. And a lot of the forward growth, the next couple of years growth is already being priced in. So the defense PSUs are one segment where I would say be a bit cautious. Oil and gas, another segment where we would be a bit cautious because of the reasons I just mentioned a short while back. But like the banks, for example, the PSU banks, they look okay to us.
Okay, fair enough. And we've also seen quite a bit happen overseas when it comes to the kind of rate cut cycle that now yet again will kick off in September. Just going by the kind of indications that we're getting from there, what is it that you're expecting from our own Reserve Bank, or how the Indian markets could potentially react to that, and what it could do to the bond markets globally and back home?
So this could be a pretty interesting inflection point for the markets. Last few years, we've seen interest rates going up and then staying high. Now you're probably entering a phase of a global rate cycle cut, a cutting rate cycle globally, with the Fed, the Bank of England, and the ECB likely to cut rates. Even China has done some minor tweaks on the way down. It's only the BOJ, the Bank of Japan, which is nudging rates up. But there again, remember, the Japanese interest rates are very low. The 10-year Japanese bond yield is just about 0.9%. So in that context, with inflation being in control, in India, with global central banks cutting rates, we think there's a strong case for the RBI to reduce rates as we get into the end of this financial year, end of this calendar year, and a little bit into the early part of the next financial year. But we expect this to be a shallow rate cycle, a rate cut cycle, we're not expecting very sharp rate cuts of 200 or 250 bips. So we think it'll be somewhere between 50 to 75 bips. Obviously, we'll have to see how the inflation data pans out, what the central banks globally are doing. But I think one takeaway as far as the equity markets are concerned is that typically when the rate cut cycle begins in the US, the dollar tends to weaken. That in turn increases risk appetite. Money tends to flow into emerging markets. And India, although it's somewhat expensive versus other emerging markets, we could see some renewed FII interest with a little bit of a lag in the next few months. And at a time when you've got strong local buying, which is likely to continue, if you start getting some foreign buying as well, that could be quite bullish for our markets. But that's just a flow argument, not a fundamental based argument. But in the short term, that can happen. So let's see how things pan out over the next few months.
Pratik, for the market to even consolidate from here, and I'm not even talking about a full-fledged correction, do you think it'll largely be globally triggered as opposed to domestic when it comes to India markets?
The correction part, yes, we're really struggling to see any major triggers for a sharp correction in India locally. The earnings season has been okay. We've seen some modest downgrades, but we're still penciling in roughly a 15% earnings CAGR for the Nifty in FY25 and 26. Interest rates, like I said, we think are heading down, so that's there. Valuations are expensive, but it's really in the pockets in certain segments where valuations are excessive. But by and large, the macro environment is very, very stable. So that, and especially relative to other emerging markets like China, for example, India still looks relatively more attractive. So to that extent, the local factors are not really major. There's no major political event coming up. The general elections are out of the way. You could see some regulatory changes from SEBI, but that will probably impact mainly the options market, not the underlying cash market as much. But it's really the global factors, whether it's a turn in the US inflation, wherein inflation surprises on the upside, or anything on the geopolitics. Oil could spike up if the Middle East, the Israel-Hamas war gets out of hand, or something to do with China. So those are the sort of risks one really worries about rather than anything local. As far as the local flows are concerned, in the short term, we just don't see any reason why they would just collapse.
Right, makes sense. Okay, time will tell which way we actually head from here. But so good speaking with you today. Thank you for taking the time out.
If you like this video, then like, share and subscribe to ET Now.